Concerns over the Federal Reserve's rate hikes tipping the U.S. into recession have reemerged. Last week, Fed Chair Jay Powell signaled more interest rate hikes are likely to come this year. The market expecting another quarter-point move at the Fed's July meeting. Can the Fed's playbook help the U.S. economy defy odds and avoid a recession? Let's bring in Vincent Reinhart, Dreyfus and Mellon chief economist, to discuss. What are the odds, I guess, at this point, Vince? Kind of where do we stand, and what do you think the Fed is going to do at its next two meetings?
It's tough to worry about a recession on the morning in which housing came in so strong. If it's a recession, it's going to be a different kind of one. And I think most likely the economy will slow pretty markedly in the second half of this year into next year. That doesn't matter for what the Fed's going to do at its next meeting in July. They're going to raise rates a quarter point because they pretty much told us they'll do that. They have projected that they'll increase in total a half point by the end of the year. But that second step is a little more doubtful, exactly because the concerns about the economy are going to start mounting.
So does that just mean a cut is off the table anytime soon, even for those who have kind of bucked the trend out there and economists that have said, we could potentially see one if things get dire enough or if they get worse enough to the point where the Fed has to acknowledge it?
You can talk about cut, but you also have to add in the fullness of time. They're pretty clear that nobody on the policy setting committee expects rates to be cut in 2023. The recession dynamics we're talking about happen quickly, but it's not this weekend. It's going to take a little bit to evolve, and it's going to take a while for the Fed to recognize it. And meanwhile, inflation is stubborn. It will be above the Fed's goal still, and they're going to have some hard policy choices. So in fact, what the FOMC has accomplished in the last meeting cycle is mostly convince investors that the funds rate is going to a plateau in 2023, and it's going to stay at that plateau. No rate cuts this year. Whether that plateau is a quarter point higher from here or a half point higher from here is subject to more debate.
Has the Fed done a good job in communicating that message? I think about Christine Lagarde, the ECB president, who spoke today, pretty universally seen as a fairly hawkish message, a clear hawkish message. Does Jay Powell need to take some lessons from Lagarde, or do you think he's been clear enough?
So I think Chair Powell has a committee that he's got to corral into the policy decision. That's one problem. I kind of think he's a reluctant warrior. That he, among the members of the FOMC, are the one of the ones least inclined to tighten much more because he thinks there's credit constraint coming down the pike. Last meeting was a modest policy mistake wrapped in a communication error. The communication error is they didn't give a good rationale for pause. You saw it in the press conference. They said they're awaiting more information to make a better informed decision. That's why they didn't raise rates in June. But they also raised their forecast a half point for where the funds rate will be within 6 months. Explain to me how you could get enough information to revise your forecast up a half point, but it isn't enough information to make you want to change the current policy rate. That's where they didn't do a good job communicating.
Yeah, and Powell kind of downplayed the forecast, right? That I heard one commentator actually call it a horoscope. So I guess people suggest people should take it with a grain of salt. It's ironic, Vincent, you say that the Fed chair didn't do a good job of communicating the rationale for a pause, if in fact you think he's really the one who wanted that pause, right? Or even would want the FOMC to be done. Why do you think he's not getting the message out better?
So the most time-honored technique for a chair to put off their committee is to say, hey, we'll know a lot more in 6 to 8 weeks. And that's exactly what Chair Powell did. I think when you listen to some of his answers and testimonies when he was up on the Capitol Hill delivering the semi-annual testimony, he's waiting to see credit constriction. We had bank runs in March. We were really worried that this was going to turn into a systemic problem. It didn't thus far, but those sorts of sudden withdrawals from banks, according to Powell, should be associated with a constriction on credit, 6 or 9 months later. We're coming into that window. He wants to see some evidence that maybe the quantity channel of policy constraint is kicking in a way that the price channel, what happened to the rate, has done so less.
The employment situation on part of the Fed's dual mandate, that's remained resilient and thus has led to a resilient consumer, even showing up in some of the consumer confidence data that came out this morning, saying in commentary, assessments of the present situation rose in June on sunnier views of both business and employment conditions here. And so if we continue to see an employment market or a labor economy where consumers would point to and say the opportunities are still plentiful, then how does that make the job of the Fed that much more difficult at the same time that they are still in their tightening process?
And add to that, part of what is facilitating consumers' optimistic view of the economy is that equity markets are doing well. Risk markets generally are doing well. Here's the irony for the Fed. The less they're believed about their longer run policy intentions, the more receptive markets are to the situation, the more aggressive pricing is, the more the Fed's got to tighten. They have to offset that strength coming from consumer enthusiasm, from a buoyant equity market, because what's their goal? Their goal is to slow the growth of demand so that production moves into better alignment with output. Employment gains of 339,000 workers a month just isn't consistent with that. And their problem is this is a really low productivity economic expansion. We're just not getting much output per hour. And so a lot of things are diverging. We're adding a lot of employment, but we're not adding as much output.
Vincent? Sorry, go ahead, finish your thought.
No, go ahead, I'm done.
Well, we have to have you back here soon. Vincent Reinhart, who is the Dreyfus and Mellon chief economist. Vince, great to have some of the time with you this morning.
Okay, thank you.